Hey, good afternoon, everyone. Thanks, everyone, for taking the time and joining us. We want to just cover some of the key areas that of interest to all of you. So today we'll spend a little bit time on how our journey has been, and also a little bit talk about uh, where we are and what we are going, and we'll cover those areas. With that said, broadly, I think given the fact that we'll try to keep some of the things a short way because some of the things you probably would know. But broadly, altGraaf as a platform, we pride ourselves in trying to create a very good horizontal distribution platform where we have an opportunity to bring different type of fixed income products that would be really attractive to the investors and bring it on the platform. And as a mission, this provides an opportunity for the investors to participate in a variety of products, not only from the product structure standpoint, but also from a standpoint of the borrowers that we are bringing who are will be in different types of forms. And this gives us another avenue in terms of investments when you look at your overall portfolio, in addition to your equities, fixed deposits, real estate, and everything. And I think this could be a good value addition to your portfolio as you look at overall alpha returns. Right? Broadly, the team, all of us kind of manage on a day-to-day basis. We have been there, done both domestic and international markets broadly, and spent quite a lot of time. And we believe that this is a good mission for us in terms of creating value for customers. And that's how we have started here. And we've been backed by good global VC funds as well, which you are kind of aware. So I'm Jay Prakash. I've been in the financial services for more than 18 years. I've been in business lines purely on the financial services space across different business lines, both domestic and international markets. I manage some of the growth efforts at altGraaf. So, I'll try to go very fast. I think broadly, we pride ourselves in creating a good platform. And in the platform, we have an ability to connect both the borrowers who are looking for raising capital with investors. And we do curate different type of borrowers who are looking for raising capital. And we bring those opportunities and investment opportunities to the platform. And we try to provide all the information tied to the investments opportunities for the investors to bring it on the platform. Then we allow the investors, partners, institutions as well, who kind of look at the opportunities and kind of look at what their risk appetite is. And based on the risk appetite and also how they want to diversify across different investment opportunities, they kind of uses the platform. So that's broadly it, which, and I'm sure if there are any questions you'll ask, we'll try to answer them. Go to the next slide. Okay. So broadly, when we kind of thought about how we are looking at passing this journey, we looked at it, and there's a lot of information with respect to the equity markets. And when it comes to the debt market standpoint, there's a lot of folks looking at whether debt as a product and a fixed income option could be a valuable addition to the portfolio. And when you looked at it, obviously FDs play a large role, but are there other products in the fixed income space that can provide a decent yield, and can I access them and add to my portfolio? That was one of the biggest challenges. That's how we felt the fact that while when you bring these kind of opportunities, big data value addition to the customers, and some of the opportunities which are still there and has been there for a long time is about all the structured credit products, which are very much easily available to the ultra-rich and nice, but it was not much available to individual investors who are looking to add some information. So we wanted to make sure that we have an opportunity there as well. We can access to those kind of products, and that's one of the reasons as well, which is the biggest challenge for us. So then other thing also is when you have these opportunities coming onto the platform, what kind of mechanism we can have, or can we build a mechanism for us to evaluate this so that there is some sort of curation that can happen in the early part of things, so that these deals that we are curating and bringing to the investors are of something that will be much more attractive to the end investors. And how is that investment cycle going to be, and how the monitoring would have to happen, and how we manage the data and everything. That's also a big of the challenges that was felt by the end investors, and we wanted to aim to simplify it for as a platform for the benefit of the investors coming to the platform. And obviously, other things needs to go. When if you are really looking at creating a deal opportunity, there is a set of process that we need to go through all the way from evaluation. If there's lead that needs to be done, we have to do that. All the process and documentation that need to happen with all the different borrowers who are raising debt capital, along with the investors. All of that is obviously, and that also we want as a platform, try to simplify it on behalf of the investors. So these are the things that we were trying to tackle as we were trying to bring the platform. These are some of the things that I'll probably put it that way. And that's what we were aiming for when we kind of had this platform, and we've been for more than 2 years now. Next slide. So, and this is a very small, I would say, a sample of the different borrowers that we brought on the platform. I think, as I indicated to you earlier on, our endeavor has always been how can we curate uh, different investment structures through different products on the platform, and also how we can diversify ourselves in bringing different type of borrowers who are trying to raise capital onto the platform, whether it is the manufacturing side, e-commerce side, we're talking about jewelry area, we're talking about infrastructure, you're talking about fashion. So we want to make sure that we have an opportunity to not only focus on the product structures, but also the different type of borrowers in terms of and bringing it to the platform. And when we bring these opportunities on the platform, definitely the risk is not same from one borrower to another borrower. So obviously your returns will also be similar or probably correlated with the amount of risk one is taking. So we want to make sure that there's a good amount of variation and opportunities and choices are there for the investors in terms of how much return they are looking to get, all the way, whether it is very low return or the high return, very low risk or into high risk, right? So these choices we want to give it on the platform so that the investors have an opportunity to not only diversify, but also choose based on what the risk appetite is and participate accordingly through all. And I think we'll cover a little bit on this specifically, but we have done more than almost now about 50 plus 60, I think, closed of type of different borrowers that we have brought on the platform across the different product types. So this is one thing that we consciously we want to do it, and we are working on a day-to-day basis, and we have done a good deal amount, and this is something we'll continue to do as well going forward. So what we offer, as I indicated to you before, we focus only on the fixed, and we don't go into the non-market linked opportunities of equity. We focus on the fixed side, and we always say the fact that our endeavor has always been a choice for somebody to add something more to their portfolio and diversify compared to traditional debt products. And obviously, the returns would be tied to how much of risk adjusted risk, high risk. It obviously the combination would be there. We wanted to definitely focus on the credit risk processes that we undertake in terms of curating each and every deal, and we want to bring only the curated investment options, the choices that we bring on the platform, and these key pillars about how we curate, how we go through the process on each and every opportunity, and how do we create the choices for the customers and create the diversification of the customers are the things that we go on a day-to-day basis when we kind of curate and bring deals to the platform. Next one. Okay. I think this one, I'm going to quickly run through it. I think given the fact that a lot of you would have already seen the projects, I mean, as I said, these are the different product structures. Majority of the, I think if you look at we from a corporate debt, whether it's a commercial paper or the bonds, the commercial paper, which would be a very short term in nature, 3, 6, 9 months as well, it can go. We have done mostly in 3 month side. Unsecured in nature, shorter duration, which I told you. Yields will be depending on the risks, but typically it will be 7 to 1, but it will be tied to how much the risk will be as an unsecured paper. And corporate bonds on the unlisted corporate bonds. So these are not listed on exchanges. And we have done unlisted bonds, as I said, category wise on the real estate side, commerce. So there's a lot of different categories we go there. Secured in nature, there is underlying collateral that will be there, and the underlying collateral could be any different, could be on the receivable side. The leasing side will be hard assets, but broadly there is underlying security tied to it. In the event of there is something of delayed payment that happens, tenure 12, 36 months. Yields can vary. Again, it is purely a question of how much risk, how much return. So it has both lower risk, lower return, which should be a highly rated A bond compared to a little bit higher risk, triple B plus, triple B. Then obviously the returns would be a little bit higher tied to it. Obviously, the amount of yields and returns would go correlation that way. Invoice discounting, mostly short-term product, unsecured in nature, primarily used for working capital. Again, yields vary depending on the counterparty. Leasing is a purely an aspect of ability to generate income on investing in assets which are income producing. So Your underlying asset is an hard collateral, cars, loans, tractors, and all those things. So you're actually investing in an NCD structure where your secured securities in the form of hard assets that are generating the income. Typically 10 years, 15, 36 months, the yields would be a little bit on the higher range because the tenure also will be longer than the typical one. Again, risk return framework will work. Venture debt, we have done some venture debt in our platform. This is purely focused on companies that are growing in nature. Tenure will tend to be a little shorter on this thing with the higher yields. And again, here also generally it is secured with some sort of assets as underlying collateral. Okay, I think I quickly went through it. I'm sure if there is a question you brought, I think we'll focus a little bit on the curation process. I think I'll probably bring in Pratik here. Pratik, I think one of the things that we really wanted when we look at all the opportunities that we curate on the platform, they go through an extensive curation process. Maybe you can spend a little bit of time of the steps and the due diligence that happens when you curate each and every opportunity and every counterpart.
So, thanks, JP. I think our endeavor always has been that we want to offer our platform members the opportunity to create a fixed income portfolio across the risk return spectrum. And in that sense, we have an in-house team that goes out to the market and sources these opportunities. We get a fair amount of inbound opportunities also, companies that are looking for capital that approach us. But we have a team of about 8 people that go out in the market, talk to various market participants, work alongside banks, NBFCs, funds, and try and source good opportunities. When they find them, then they do an initial assessment basis the financials of the company, basis the governance structure that they have, basis the various tools that are now available, such as Probe 42, which can give some background about the company, and present an internal first cut of the paper whether the team would like to spend more time on that opportunity or not. And that broadly covers the market standing of the company, the unit economics of the business model, the positioning and the competition aspects of the company, and how the company's track record has been. Basis that, there is an internal investment committee of 6 people that gives a view and asks certain questions to the investment team, saying that, look, these are the questions, these are the worrying points that you should maybe answer before they can move forward with a particular proposal. The investment team takes these questions back, typically works with the borrower, understands them in a lot more detail. This whole process takes about 1.5 to 2 months to actually onboard a particular borrower. And once an in-depth diligence is finished, then there is an internal credit memo that is prepared. The IC then looks at it, opines whether that's a yes or a no. That then further leads to the next stage of documentation, agreement with the company on commercials, legal documentation on the particular structure that's been agreed, and eventually the deal finds its way onto the platform. Broadly, that's been the process. You would find that we have tried to model it quite similar to any other financial institution, be it an NBFC or a bank, because we want, when we source the opportunities, our process eventually should be robust enough, like a mature financial institution would have.
So Pratik, I think one of the questions normally I used to get would be is, as part of this curation process, there will be a lot of I'm sure a lot of companies, whether it's a small size, mid size, or even a public company, will be looking to raise their capital from a standpoint through our platform. And so the curation, so we would get a lot of folks coming and asking for help with raising capital. So can you quantify in terms of like how much timing it takes for us to really approve a particular deal? And
see, the top of the funnel is quite heavy, because over the last 2.5 years, we would have maybe looked at 700 to 800 different opportunities, and we would have eventually only about 55 or 60 of them have found their way on the platform. But that number of 700 and 800 is a little misleading, because you can practically look at one glance and maybe reject 50% of them outright. Because a lot of the inbound leads specifically are people who are desperate for capital but don't have the ability to actually absorb debt. The balance 50% might have gone to stage 1 to stage 2. And then eventually you might have a set of 100 borrowers which are really reaching a serious stage, out of which maybe 55 and 60 of them have found their way onto the platform. I would also say some of them are in the process where they are in a warm lead stage, where we are also saying maybe they will get better with time, maybe their unit economics will improve, maybe their leverage ratios will come down, and eventually we can engage with them 3 months, 6 months down the line. So we continue to engage with anybody who approaches us for capital. And as their business models evolve, as the credit cycles turn, then we see what's the best time to bring them onto the platform.
And how long does the normal process typically go? And assuming that we are not rejecting on the first stage.
Start to finish, typically 2 months, but it depends on how quickly we get access to the data. It depends how complex a particular business model might be. But yeah, if you look at our average over the last 2.5 years, it would be typically 2 months before we get a new counterparty onto the platform.
And do we specifically focus on any sectors? Or I'm sure we are looking for diversifying across sectors. Would you say, like, do we create a preference for any sectors also?
We don't have a preference for any sector. We are sector agnostic in that sense. That goes along with our theory of diversification. We do watch out for sectoral trends, and we do follow the market to understand if a particular sector is undergoing any level of stress, if there are any warning signs on a particular sector, and we might want to slow down. But that strategy keeps moving quarter to quarter. As such, if you look at it over a long period of time, we don't have a preference for any particular sector.
I think you're covering the next slide, like what kind of information we probably look when we are curating a particular opportunity.
Yeah, I think broadly for the audience, what we try and do is look at some of these aspects when we are looking at a particular business. And I would first focus on the bottom left, which is the due diligence part. The first thing obviously is to understand what is the management of the company, who are the people involved, what is the governance aspect, get some feedback on them, and see if they are people who have a reasonable track record and there are no conduct risk on them. Then you get to the next stage where you start to look at their financials, you look at revenue visibility, you look at margins, you look at the company's scale and market position and determine where is the company heading based on their track record and the projections that they have. And then you get into the third aspect of the risk, which is, do they have any concentration to a particular customer? Do they have any other regulatory risks that might come their way? Do they have exposure to any other international market risks that might come their way? We try and then triangulate information using the balance sheet and the financials that's been provided by the company. We then use instruments such as Probe, platforms such as Probe, Corpusitory to then triangulate this information. We also do ref checks from other borrowers. We do ref checks from some of their shareholders. And then if all that adds up, you would look on the right side of the slide. We sort of try and determine where do they fall in the 5 broad category heads that we have. A company can essentially fund itself from these 5 sources of capital, which is either they are really profit generating and are now become self-sustaining, and some of the really good companies fall in that bracket. Then the third is they have cash in hand. The third is where they are taking debt. The fourth is then various forms of equity. One is existing shareholder support, and the last is external shareholder. And we've also tried to then sort of classify them on what we think, rightly or wrongly, and different people can have different views on it. But we've tried to put out what we think is low risk and what we think is very high risk, where if a company has become self-sustaining, if they have adequate profits that covers all their obligations and still yields them a surplus, that's typically low risk. To people who are dependent externally on external funding, that's typically high risk. But whenever we are looking at business and industry and specifics aside, these are some of the factors that we go into before any opportunity finds the way into our process and goes ahead in it.
So Pratik, while the process is there, I think the framework is there, there's a lot of due diligence, and you're talking about a cycle time about 2 months. How do you consider this from a standpoint of doing all of this? Good things can happen beyond what's not seen from a standpoint of being foolproof.
I don't think any financial instrument is foolproof. All financial instruments carry risk. Whenever someone is investing, you put money in an FD, it carries risk. It then has whether the bank can go down, and then there is an insurance layer. Sure, the risk is low, but the risk exists. You give money to a government, There are instances where the governments have collapsed and they have had defaults. Greece, Argentina are examples of it. So whenever you are investing, there is always risk. There is nothing called foolproof. I think all investors understand the idea is to have risk-adjusted returns. The idea is to find balance between risk and return. What we try and do on the platform is to curate opportunities across the risk and return spectrum so that people who want, let's say, a 7% return are happy with that and say that, look, my money should be relatively safe. Then they find a commercial paper, they find treasury bill and can invest in it. People who are saying that, look, I want a 10% yield can find corporate bonds and can invest in it. And people who say, no, I want a 15%, 18% return can find those high yield opportunities and can find those structured credit opportunities and can participate in that. The idea is at least they will have a platform where they can get access to credit opportunities, create a portfolio for themselves, and have that risk-adjusted return.
I think so. From that angle, obviously, as a platform, altGraaf had an instance where there was a counterparty which has significantly delayed the repayment. So, how do you classify that as a platform? Did they fail the credit process? Like, maybe you can talk a little bit about what that case specifically would have happened.
See, in our last 2.5 years, and we have now done about 3,000 crore of transaction volume on the platform, we have had one instance of significant delay. There is reasonable chance that even in that case, capital might come back. There are various factors to it, and I would not go on this webinar on the specific factors of that particular case. But there might be a resolution process in which case the capital might come back. When there is an instance like that, you can always say that there is some problem with the credit framework. And we take that feedback very well. There is always room for improvement. We'll try and improve. We hope that over the last 2.5 years, we've demonstrated that we've improved as well, but we'll continue to do that. The thing is, when you're taking risk, instances will happen for various causes that will play out and actually jeopardize capital that's been put at risk. A simple instance could be fraud. If there is fraud by any of the counterparties, the entire capital is at risk immediately. There is then business-related risk, could be business cycles, could be counterparty, could be specific instances of delay. And then you will have to exercise either your legal rights or wait for a resolution process. There could then be instances of external factors sort of impeding any particular repayment that's been due or any particular borrower or any counterparty that's there. The thing in debt and the thing in fixed income would be that you will have a legal course, you will have certain, depending on the instrument, you will have certain recourse to the assets or to the balance sheet of the company. And then you will have a process to recover capital. Whether we like it or not, the reality of India also is that the process is slow and sometimes the process itself is the punishment. But nonetheless, there is now increasingly with the support of the regulators and with the support of the government, that process is becoming tighter and tighter. Hopefully, if you follow a reasonable framework for a long period of time, as a financial institution, you can only decrease the probability of such instances. Such instances will happen because that's the risk that everybody carries. That's the risk our investors carry. That's the risk as a platform we carry. And that's the risk as individuals we carry. But hopefully, if we look at a reasonable journey, and I'm quite proud to say that after 2.5 years, we have only had one single incident and only about 0.6%, which is in delay. But it's up to us to keep that track record and hopefully improve upon it.
Thanks for that. So I think from we can take, I think so from an investor standpoint, I think it's very important for every investor on the platform to understand the fact that all of these investments do carry risk. And the best way for would that be then if I want to as an investor want to invest on platform, I'm sure a diversification is important. How do I go about it then? I think what would be the best way?
I think there are 3 key steps to creating your own portfolio. One is to understand oneself. Where is my comfort in terms of risk and return? I mean, everybody wants high return at low risk, but that doesn't exist in the world. So once an investor has identified their own comfort, then I think there are 3 levels of diversification that people should at least strive for. One is the instrument level diversification. In fixed income, you have secured bonds, you have unsecured bonds, you have commercial paper, you have invoice discounting, leasing, all have different kinds of underlying assets, all are different instruments. So one is to invest in different fixed income opportunities. So that's the instrument level diversification. The second one is obvious, invest in different counterparties, invest in different opportunities so that if one goes down, your rest remains safe. Then the third aspect of that is maybe also diversify in sectors, maybe also diversify in different market themes. And overall, then like an NBFC or a bank would have, if you have a reasonably diversified portfolio for any financial institution, for any investor that is operating in that 10 to 15% yield bracket, your problem area would be in that 1 to 2% bracket range. That's the trend that's been in India. You chart any mature financial institution and you will find the same sort of NPA ratios.
Yeah, thanks. I think we can.
I think in this, what we have tried to also give a snapshot is of the opportunities that have been available on the platform. And we've just tried to summarize where they fall under, and some of our investors would be familiar and would have seen that on the platform as well. I think on the last slide, what we just want to say is that over the last now about 3 years of our journey, we have had the benefit of customers trusting us, customers investing through our platform. We have now had in December our first instance of a significant delay. We are trying, and there is a resolution process that's been in the works, but it's also a message to us and to our platform members saying that, look, risk return will always go together. If there is a reasonably diversified portfolio, eventually the returns will outweigh in a reasonable credit framework the pain or the delay and default that might be there. We think our track record so far has been good. There is always room for improvement, but we hope that we can continue the journey onwards and hope to continuously improve our credit framework as well. We would like to thank everybody for participating on the webinar and for asking your questions. We hope we've been able to tell you more about altGraaf, to answer some of your questions, to give you a perspective on our process and on our track record. Our team is available in case you have any questions. Please do write back to us, and hope you all have a good evening.